So, when you think about being financially safe, what's the first thing that pops into your head? Maybe a savings account, your 401k? And yeah, those are great for sure, but they don't cover everything. What about those curveballs life throws that just come out of nowhere? Today, we're going to look at financial safety a little differently, almost like it's a form of insurance against the stuff you just can't control.
And that, right there, is really the heart of it, isn't it? We invest, we make our plans, we run the numbers, but at the end of the day, things can happen that are completely, totally outside of our control. Look, this isn't about being negative. It's just about being realistic. It's about being prepared.
So that's the big question we're tackling in this explainer. I mean, you insure your car, you insure your house, but when the unexpected sucker punches your finances, what's your policy then? What's your actual plan? Let's dive in and figure that out.
Okay, so to really get the solution, we first have to wrap our heads around the kinds of risks we're up against. And, it's often the biggest, scariest risks that we prepare for the least, especially when the entire system itself is feeling the pressure.
This right here is a perfect and pretty painful example of a disaster hitting just one company. Before the Deepwater Horizon oil spill, BP stock was humming along at $60 a share. Then, the uncontrollable happened. And just like that, the stock price was literally cut in half. If all your eggs were in that one BP basket, you were in a world of hurt.
But then there's this other, much bigger threat out there called systemic risk. This is when it's not just one company having a bad day, but the entire system has a massive problem. Think back to the subprime mortgage meltdown in '08. The classic advice to diversify your investments, it just doesn't protect you from something like that.
And I love this analogy because it just hits the nail on the head. Diversification is like spreading your eggs across a bunch of different baskets. If you drop one, hey, the others are safe. But systemic risk, that's like the entire floor collapsing from underneath you. It doesn't matter how many baskets you have. All the eggs are in serious trouble.
So, if diversification isn't the whole answer, then what is? Well, let's try to shift our thinking. Let's stop calling it just risk management and start thinking about it as a true insurance policy for your financial life.
And this is the key. It's such a simple but really profound principle. We can't control if a hurricane is going to hit our house, so what do? We buy homeowners insurance. We can't control a market crash, so we need to have some kind of financial hedge. We need our own version of insurance.
The logic here is exactly the same as insuring your house. You pay a premium for something you really hope you never, ever have to use, but you're so glad it's there, just in case disaster strikes. A financial hedge works the same way. It's a cost, yeah, but it's a cost to protect your entire portfolio from those catastrophic floor collapsing events.
Okay, so what's the most basic, most straightforward form of this financial insurance? Well, it's something we all get, good old-fashioned cash. In the world of investing, this is called your cash position. You've probably heard it called an emergency fund. It's your just-in-case money, sitting there, ready to be your first line of defense, or maybe even let you scoop up some opportunities when everyone else is panicking. The common rule of thumb is to have about 3 to 6 months of living expenses saved up.
But, and this is a big but, like any strategy, just holding cash isn't some perfect magical solution. In fact, doing nothing with your money comes with its own set of very real and kind of hidden risks.
There are really 3 big ones to watch out for. First, and this is the big one, inflation. Every single day your cash just sits there, it's actually losing its buying power. Second, there's opportunity cost. While your money is parked on the sidelines, you could be missing out on some serious growth. And finally, believe it or not, there's even physical risk. Stashing cash under the mattress is not nearly as safe as you might think.
So if holding cash means you're slowly losing to inflation and missing out on opportunities, how do you build a defense that actually grows? Well, this is where we see a huge shift in mindset, from just playing defense to actually playing offense with your money.
It really boils down to this. Amateurs and professionals have a fundamentally different way of thinking about their financial goals, and it's a supercritical distinction that separates just preserving wealth from actually creating wealth. And here it is. The amateur is always trying to buy low and sell high, right? They're chasing that one-time payout, that capital gain. But the professional, they are obsessed with building consistent, reliable streams of cash flow. This slide just lays it out so perfectly. The professional's goal is to buy assets, things like dividend-paying stocks, rental properties, maybe a small business, things that generate income. You can see how that income flows from their assets over to their income statement and right into their pocket month after month after month. So the huge takeaway here is that the ultimate goal isn't just some big net worth number on a piece of paper. Your net worth can't pay your bills. Cash flow can. The real goal, the true end game, is to get to a point where the monthly income from your assets is bigger than your monthly expenses. That, my friends, is what real financial freedom looks like.
And that brings us to the final and maybe most important question. When you really look at your own finances, what is your strategy truly built on?
On one side, you've got hope, which is basically a total lack of control. Oh, I hope the market goes up. I really hope my stock recovers. And on the other side, you have a plan. You've thought through the possibilities. You've put insurance in place. You have a good idea of the potential outcomes because you've actually prepared for them. So I'm going to leave you with this final thought. An insurance contract isn't based on hope. It's a promise. It's a guarantee. So when you look at your own financial future, is it built on the fragile foundation of just hoping for the best? Or is it built on the solid bedrock of a promise you've made to yourself, a real plan with real financial insurance built right in?